So many financial contracts and an entirely different landscape for retirement. Today, we have someone with professional experience on multiple levels. We have Suzanne Norman. Welcome, Suzanne. She is an education fellow for the Alliance for Lifetime Income.
Welcome to Jay's Corner. My name is Jay O. I am the certified financial planner. I'm also the author of Maximize Your Medicare, the published book. Jay's Corner is there to try to explain how certain financial matters work, to try to help you separate the signal from the noise, so that when something changes, you're not distracted wrongly, and instead keep your eyes on the ball, which is tough to do given the way that we are given information. There's a free and paid newsletter. Go to jo.substack.com. There are 2 YouTube channels, Jay's Corner as well as Maximize Your Medicare. Be sure to like and subscribe to this podcast on Apple Podcasts, Google Podcasts, anywhere you digest your podcast. Be sure to leave your comments. Let's begin.
So many financial contracts and an entirely different landscape for retirement. Today, we have someone with professional experience on multiple levels. We have Suzanne Norman. Welcome, Suzanne. She is an education fellow for the Alliance for Lifetime Income and also expert with a wealth of experience from different levels in financial services. Welcome.
Thanks, Jay. Great to be here.
Today, we're going to talk about annuities. Let's start at annuities. And you had the greatest comments. You know, there's a lot of negative talk about annuities, and you can just recount how many conversations, I don't like annuities. I don't like annuities. Mm-hmm. What's your first reaction?
Well, I liken it to having been in the industry for 30 years and loving the ability to learn all sorts of new things. That's one of the most exciting things about the innovation. But the point I make when somebody says out of hand, I hate stocks, my answer is always going to be all of them. Right. And of course, being a coach, I'm always curious, because there's got to be something that's forming that perspective. So connecting back to your comment, which is it happens probably more frequently that someone is saying, I hate stocks, but someone out of hand saying, I hate annuities, whether that be an investor or a financial professional. And again, my question is always, which ones? Because it's like that example. It's, you got a lot of stocks out there. You also have a lot of types of annuities. So, and I don't know that people understand them.
And we're not going to, discuss every different type. It's more about, kind of the education and whether or not we're doing a good job about explaining. So from your perspective and, Alliance for Lifetime Income, and we can talk about them or your role in them, whichever way you want to go. But just generally speaking, how would you rate, from a scale of 0 to 10 of annuity providers, advisors, planners in helping people understand how annuities work? First, let's start there. How would you rate the quality of education that's out there?
It's confusing. And I think a lot of it was back to the lack of financial kind of literacy that most people have. We don't necessarily get an education in this country. We might be lucky enough to have chosen to be in an industry that gives us an education, but most people, kind of DIY it. And the fact of the matter is that because annuities are a legal contract, there's a lot more that goes into them as a practitioner, someone who doesn't advise anymore but did. There's a lot to know. There's a lot, you might get a prospectus that's 120 pages. You might get a contract. So if Jay, you're my client, and I go through this learning process to figure out, what kind is going to serve Jay's needs, right? Because of course, like any investment, what are your objectives? And what tools do I have as a practitioner that can help you achieve them? But the annuity contract itself is long because there are guarantees. And really at the core, I think, when I think about annuities, it's an income stream. And that's where it started, we could say 1,000 years ago. So they've been around a long time. I think the innovation in the industry probably added to a little of the complication and misunderstanding because it used to be pretty straightforward. You give an insurance company, maybe through a financial advisor, an insurance licensed financial advisor, a lump sum of money, and in return, you get a payment stream for life. I mean, that's kind of the basic concept of an annuity, but adding a lot of different, enhancements, we'll call them, added to this confusion, especially by financial practitioners who said, I've got to know all these other things, and I don't necessarily have as many clients that I'm serving that have income needs. But as we look at this peak 65, a term that was coined by Jason Fichtner, who leads the Retirement Income Institute, where I'm a fellow, there is a wave of people coming, and everyone knows that, right? So you've got people coming into retirement that may not necessarily have saved enough money. They might be, relying on Social Security. I don't know that that's going to take everybody through retirement. They may not have any pensions to draw from. So the annuity need is really much more front and center in conversations. So I think advisors are picking up on that.
Do you think that when you're employed, you're contributing perhaps employer match on 401k, and now rules have changed in terms of accessibility to annuities inside the 401k, for example? How much of, like you pointed out, the function I think is very well stated, which is you're depositing money for X period and turning it into a lifetime stream of income. That is a particular function, which is quite a bit different than your overall financial advisory, financial, instrument information, where we get told of, growth and, I bought, Amazon at $1 a share or something like that, and stocks for the long run, this kind of thing. Do you think that we ourselves in the financial industry, or what can we do to improve our communication or questioning conversations with end clients along these lines?
Yeah, I think it comes back to that ability to be in a constant learning mode, because just because this is the way we've always done it doesn't speak to the need of the client that may say, yes, Jay, as my, Suzanne's the client, Jay's the advisor, you have taken me through my earning years, right? So I've had a great career. I've been able to accumulate money. I'm grateful for the advice that you gave me on how I could invest it properly and grow it and accumulate it. But now that becomes my pot of gold that I need to draw from. And I hate to, reference this because, it's not a fun experience to have, but for anyone who's actually been unemployed and didn't have that constant paycheck coming in, that's what retirement's about, right? Meaning, you're not assuming you're not working, right? Where, you've got to figure out, how am I going to continue to pay, a mortgage or rent or, utilities, groceries, and the advisor that looks through that lens and is curious about that lived experience for an older person. I'm 56, so this is certainly on my mind all the time. I live it, of course, with the consulting work I do and the coaching. But I think the advisors out there are also aging, so I think this is on their minds as well. But I think coming at it from the perspective that we are in a shift, right? Where it's also, I always say, life is an and, not an or. This binary nature of, annuities. Well, that's not the only investment you're gonna make, right? You're gonna continue to have, you already mentioned, an Amazon story where, you've got a stock that has growth potential, and maybe, is gonna raise its dividends. So the point I make is, or the bottom line with the financial advisory industry, helping serve clients, is recognizing that the needs are shifting, and that liability management of making sure that there is a secure retirement income stream is happening more and more.
Do you think that clients quickly enough, people enough, you mentioned, your age, and let's call it what is it, Gen X?
I am Gen X.
I don't know what the labels
sort
are.
of on the cusp, but yeah, I'm Gen X. Yeah.
Let's just call it that, right? I mean, at least you took out your telescope and you can see a retirement age at some point, right? And not today, of course, but that at some point the transition from accumulating, you of course can, earn an income, but at that point it's a different mindset, if you will, right? From get me to the fast track my career, get me to the spot I want, get a house, have my savings, et cetera, et cetera. But then shifting from that to orderly liquidation, if you will.
Yeah.
Is this conversation well had from your point? You have experience in, large companies, large employers. How do you think this education, is it well provided? Is it not? Is it just us talking about it? I don't know.
Yeah, I think I'm hoping that it's getting better and sort of looking through the lens again of someone who is, working for either, the government, or, corporate, whatever role, you have where there's more of a structure. I think there's better education. In fact, I have kind of rewired myself as last year. So I'm now in my sort of next chapter. But I did keep my money at my former employer, Milliman, in their 401k. And so I think a lot of companies are really good about the consumer or investor education now. Of course, they can't give advice. So that I think was one of the gaps that existed for many years, is that, how do you walk that line of helping employees actually understand what they're investing in without giving advice? But I do believe that the financial wellness kind of direction that a lot of companies are taking now has helped a lot. But as far as helping someone construct and put together what an income stream looks like for them in retirement is I think we're still in early days, because if you look at the stats, we talked about this before, that generally speaking, formal plans, at least from a financial advisor or financial professional standpoint, most clients are reporting they're only about 10% are doing a formal plan. And so without doing some projections on where, how much money you have, how that's going to generate income for you, I don't think we're seeing enough of that happening.
And that's absent at, right? So like you pointed out, at the large employers, they're not able to give that type of, not that granular per person, right? It's more general statistics about here's your balance. And you did mention, however, that a summary statistic is available to you on your specific one.
Thanks. I should point out that one of the things that has happened lately is through regulatory changes that now most 401k or 457, a defined contribution type, employer match scenario, however you're calling it, will actually now show you on your statement what that lump sum amount looks like as a picture that day, right? So, if I look at my statement, I can see a value, right? Which we all know where we are in the markets now. There are variations, but that day when they took the snapshot on the value, they're now translating that into what that income would look like for me monthly when I retire at 65. So it gives you a sense, much like if you, hopefully everybody is signed up for their Social Security statements, right? Which now it's online, so you have to do it yourself. But the point, it's not coming in the mail. But seeing what that income stream looks like. And one thing that I did want to mention, which of course the work that I do with the Alliance for Lifetime Income and the Retirement Income Institute, there's a financial tool, free, that I actually worked on when I was at Milliman. It was developed by Milliman. It's called the RISE score. And I pointed out only because what I love about this, it's fintech, right? But it's easy fintech. It's designed with a very easy user interface, just a few inputs, and no one's tracking this information, right? So it's just for you. But it translates into what looks like a credit score. So you can just plug in, where your sources of income are coming from, because it's the Retirement Income Security Evaluation Score. It's a mouthful, so that's why it's called RISE.
RISE, right?
But I love to point it out because it's one of the few tools that I've seen that allow you to kind of get a picture, again, a snapshot today of, am I on track? Because formal plans are wonderful. And if you have a complex financial life, everyone should have one, right? But sometimes maybe it's not that complex, or maybe you're just trying to get a feel. And so I do think that that's very helpful for people.
I think it's important, and maybe you can make a suggestion, etc. How hard is a consumer supposed to squint at these numbers? Because, for example, we talked about this before we, started airing, which is that we get the summary number, your 401k lump sum, here's your mark to market, as of some fixed date, whatever it would be, and then some projection. Do we need some better education? Is there some way? Well, my hope, if I could have, if I could rewrite the rules about the way that we're distributing information or education, I would say, okay, we'd have a bit bolder, and here's the assumption we're making in order to generate that, because we've got these projections, which is today's projection, or projections based on some average from the past, or some other peculiar kind of summary statistics in the interest of simplicity. We don't really live in a simple world. I mean, as of today's writing, we don't have global central banks in uniform direction to lower interest rates. We have a volatile world now. And, as I like to say, 1.7 billion people are now part of the first world economy from the fourth world economy in 20 years. And another 1.1 billion not very further south, being, in India. So, I mean, you're talking about tremendously different from the past.
Right.
Can you speak to what would you suggest to me? You can make a suggestion to me, and as well as to any person dealing with financial matters and clients. Any idea how we demystify that in terms of like the assumptions and how we communicate to this kind of thing other than some disclaimer?
Yeah. I think it's, you're right. We can get into the weeds easy, right?
Yeah.
So, for instance, if I look at, the factoring, right? So how much money do I have saved? What does that translate into? Because Social Security, you're not necessarily, they have a table, but you don't necessarily see your total pay in, at least my recollection. I didn't look at my recent one, but the point is a lot of these assumptions are going to be based on what risk-free returns look like. Now, you talked about the uniformity and lockstep of central banks. I'll only speak to the U.S. right now.
Right.
But the assumption that was being used on my September 30th statement was 3.26 on a 10-year constant maturity treasury. So that's going to sound like gobbledygook for someone listening to this that isn't in our industry, right? So all I would say is that, when people are investing your money, especially an insurance company that has an obligation to pay you if you've bought some form of annuity, and we both know there's an alphabet soup type out there.
For sure.
But typically speaking, the calculations that they're using on what that payout looks like when you make the investment is going to be based on the U.S. Treasury. And I'm not sure if that's where you were taking me, but, to keep it simple, risk-free money, risk-free return is typically speaking the calculation.
On annuities specifically, are we supposed to, or first let's talk about you've pointed out the function, meaning the function of depositing and then creating a lifetime income stream.
Yeah.
That's pretty clear. Why do you think it's this confusing? Like you said, is it purely because of the fact that there's a 100-page prospectus? Or is there some other reason, or negative talk? I find it very confusing that people don't understand annuities or are so biased. It's difficult to kind of, hey, given your situation, the function of the money is very important, especially what you stated. So
yeah.
You're right from Milliman, like the advisor to insurance carriers, to insurance companies themselves, right?
Not an actuary, but
no,
yes,
I understand.
Yes. But having some working with actuaries for quite a while,
sure.
Absorbing a little bit. But I actually would answer your question perhaps through my lens of being in, the financial service industry for much longer, a major brokerage firm, a major investment firm. And also knowing advisors as well as I do, having done some advisory myself. And that is that the industry came from that asset management mindset, right? Meaning I am training myself, I'm being trained to be a professional advisor for a client that says, I'm giving you money. I want you to help me invest in the capital markets, whether they be, public or private, but the point is your role is to manage my money with me. Annuities in general changed that conversation because now we've actually put the money with the insurance company, right? Because the insurance company with some form or fashion, whatever type of annuity we're talking about, is now the entity that says, we're managing. Now, as I said, most of the general account is made up of, risk-free, U.S. treasuries, right? There's a guarantee involved. So
Yes.
the money needs to be there.
Right.
And I think my observation, Jay, with where some of the pushback has come from, beyond the complexity, it's been that it changes the conversation from an advisor who says, well, now I've given the money to somebody else and I'm not really managing it. Now, variable annuities, obviously, there are, types of annuities out there where you can, have investments at the same time of an ultimate guaranteed income stream. But I do think that that's maybe, in my observation, where advisors have sometimes struggled, because it's like, well, if I'm not the person managing that money per se, then, what's my role? And I think that gets us into the shift generationally where, I think advisors that are recognizing the need of clients saying, okay, I need you to help me accumulate my money and manage it. But at the same time, now that I'm getting older and I need to draw income from the account, now I'm needing more risk management and liability management combined.
Yeah. And I think that there's your thing. And, that's a great point that, advisors are not necessarily inherently wired, not necessarily. I didn't say in every instance, of course. So is a consumer just left out to themselves? I mean, because it sounds, if they're not being talked to about asset liability, risk management, asset liability, and I'm not talking about at a big company, but your own household asset liability.
Our personal lives are an asset and liability balance sheet, right? Back to the financial literacy training that I give. So yeah, we are a business, in that sense. So I agree with you. I think that there are numerous ways for advisors to open their minds to it. I think more and more are, because they're recognizing this is the shift into this massive amount of not only baby boomers and this peak 65 we talk about, but early retirement. I mean, this is persisting. We saw last year the tabulations, correlated, whether that's right or right, correlation, causation, but there were excess retirements of 2.5 million people saying, I'm out, and someone like me saying, what am I waiting for? There are other things, purposes and passions I want to pursue, but getting back to the knowledge base that I think consumers, can go to, which is meeting the passion that I have for consumer education, is the Alliance for Lifetime Income. This is a not-for-profit that was funded by the insurance and investment industry. I mean, the members absolutely have skin in the game, but recognize that there's still so much misinformation and frankly, hunger as well on the part of people saying, okay, I'm staring down 65 or whatever age. And, I'm not sure how I get a paycheck in the mail every month. I don't know how to do that. So I do think that there are places people can go, to get that education. But I think meeting the advisor competency and curiosity with the investor need, is where this is what I see happening more and more, is that, investors are getting the education, the awareness, and saying, okay, so tell me how you're going to do this. Jay, you're my advisor. Right. How am I going to do this? Show me.
I think it was interesting because we first met because the Alliance for Lifetime Income asked me to appear with respect to healthcare cost planning, right? One of the line items on the asset liability management of your household. And, we spoke, in a previous conversation, of long-term care, of course, another different element here. Is it your view, Suzanne, if we made you the czar of everyone's household, and in terms of the plan, when's the right time to start this entire conversation? Because annuity help for people, newcomers who don't know anything about annuities, their value inherently increases by the length of time that the money is in that deposit, in that vehicle, right? A structured product, as all annuities, right? I mean, if there's a guaranteed growth element to it, then more time is a greater value. Lifetime income benefit amount, that pot, if you will, reserve pot is what I, call it in everyday speak. that guaranteed base increases with the amount of time. To plan at 68 because I've just stopped working, there's no time left. So then,
right.
How early does this conversation, information, education actually need to, how early does it need to start?
Yeah. Well, I'll put my financial literacy teacher hat on right now and say that most
absolutely.
of the studies, and Anna Maria Lusardi is also academic fellow with the Retirement Income Institute. So I learn a lot from her with her work that she's doing in financial literacy. But my point is that when the math skills are strongest, it's stickier. So, the point is high school is a great time to learn about this. Whether or not annuities are something you want to learn about in high school, I don't know. Probably not. Most companies may not even issue for someone who's younger. But my point with that retirement concept of where's my income coming from and learning about these tools that are available, right? Because an annuity, like a stock, like a bond, like a mutual fund, an ETF, these are all tools to get your objectives. I think it begins to happen as early as your 30s or 40s. And why I say that is it may not necessarily be something that you want to buy now, but recognizing what kind of instruments are out there becomes really critical as far as you're doing your building blocks. And we talked earlier about just this concept of budgeting, right? And knowing that, if I have, my income is greater than my expenses, I've met, I'm achieving the money happiness formula. 50% rule of thumb goes to my, my needs, my mortgage, my utility, my groceries. 30%, life has to be enjoyed. So that's my wants. I go on vacations, what have you. 20% goes to my long-term savings. That 20% bucket or emergency fund long-term savings is where I want to school myself on, how that's going to ultimately convert into income. Right? Because maybe you're someone who has achieved a lot of success. There's a lot of money and legacy's the real objective here. But we're talking about the average person that says, I know I don't have a pension. Social Security is clearly not going to be enough for me to afford my lifestyle. I've got to have these savings. And, your expertise around healthcare, it's going to cost a lot, especially for women. But knowing what that looks like and putting a plan in place in your, maybe I'll say 40s, but I still think 30s is a good time to be thinking because it gets you motivated, I think, to save even more money and understanding compound interest, the eighth wonder of the world.
Exactly. So I think that we're doing a poor job of educating that age division. Specifically, right? If you said 30s, 40s barely, but 30s almost certainly not, right? That high achiever, your 35-year-old Suzanne probably, while you had a technical job in this specific industry, but you can imagine.
I knew what compound interest was all about. And tax deferred savings. Let's not forget taxes, right? It's not what you make, it's what you keep. And I know that's a passion of yours, right?
Do we have good solutions as far as how to get the 30-year-old, the 35-year-olds and reach out to them? Or is that elusive still?
Depends on where you meet people where they are, right? So from that standpoint, I think that the financial wellness movement that I see, at least in corporate or, work environments, is much better because the topics are more varied. It's not just someone coming in and saying, this is what asset allocation is, this is what a stock is. It's really talking about the goals, needs, wants, objectives of someone, so college savings, the topic that clearly is maybe not on every 30-year-old's mind because obviously babies are being born much later. But, knowing what those goals are and connecting to people that way, I think is the entry point. And I do think the companies are doing a much better job. And then clearly with, financial literacy education, that CFA Society Boston, where I'm a member and an active member in the Financial Literacy Committee, is we get alliances built all over the place with adults and high schoolers, where we get to come in and teach and get people aware of things, because I think awareness is really what we're talking about here. And piquing some interest. And, like if you learn just a little bit of this, it's going to help you get that goal that much faster or more assured of reaching that goal.
if I push us deeper into the weeds here, so, I asked to talk about, annuities specifically, or, as far as complicated structured products, that kind of thing, and the negative spin from certain elements of, advertising, etc. But now you're a consumer. You've got a selection. There are X number of companies, each of which is having, 15 different selections, and inside each selection are all of these different allocation options. How do they read the illustrations, the documents, the examples? Is it ever possible that a consumer can do this by themselves, by him or herself?
Yeah, there's, I think more and more, back to fintech, there is more coming people's way, online, so that you have the ability to get some education, have compare and contrast. You still need to purchase an annuity with someone who is insurance licensed in the state that you live in, right? So if Jay, you're talking to me from California, I'm in Massachusetts, you need to have a Massachusetts insurance license, or, be able to connect me through the online organization that you work for to someone, that's licensed and also has a selling agreement, because now we're getting into the weeds with all this jargon. But the point is that you mentioned there are lots of companies out there. And if I'm an online resource or an online company, I'm not necessarily going to have all the insurance companies as my clients, right? So therein lies, another type of complication, which is, okay, so I'm with this online service, doing some education for myself, making some comparisons, but I'm only going to be choosing from the menu that company has. So if we're in this sort of binary conversation of a consumer that's doing it themselves, or an investor, or someone who's with an advisor, I'm going to go into the advisor lane for just a second. Right?
Sure.
One of the things that I like about working with a personal financial professional is that they may work for a company that has done a lot of due diligence, because one of the most basic things, back to, you don't know what you don't know, but really understanding the rating of that insurance company is critical. So much like we talked earlier about risk-free kind of, U.S. treasuries, you want to know the rating of that company. Now, again, I'm not equating it to a government guarantee by any means, but the point being, there are entities out there that will survey, AM Best, looking at the viability of that insurance company. But your financial professional may work for, a brokerage firm, whatnot, that says, okay, we have a whole team of attorneys that are going to look at all these companies and say, which ones are the most kind of, vetted, solvent, we feel they're on very strong financial footing. So I would always say, make sure that company's an A or better. And so as a consumer, whether it's advisor or on your own, recognizing that, that guarantee is really what you're buying, and knowing the quality of the insurance company.
On the back end, so now what you have is, pamphlets, etc., and if you look through the illustration and the documents that prior to purchasing, you'll get lots of different, examples of scenario A, scenario B, scenario C. From your perspective, is any of this stuff valuable, or is this largely just to pass the regulatory requirements?
Yeah, you asked earlier or before, and I didn't say it, but now I will, which is the only type of person I've ever seen who enjoys an illustration and basically an Excel spreadsheet is an engineer. Most people's eyes sort of glaze over. Now, again,
it's tough.
It is. It's really tough. And even if you are the best communicator as a financial professional, it still just doesn't activate that side of the brain that's interested, right? Which is, maybe an engineer likes that side, all the numbers, but most people are saying, I just want to know what it does. Now, again, legally and from, due diligence and being compliant, you as a practitioner have to talk about these things.
Absolutely.
But I think connecting the dots to, and we'll keep it really simple here, but if, I'm your client, Jay, and you say, okay, Suzanne, I know how much, you're flash forward, you're 65 and obviously claiming Social Security the latest that I can, unless, there's an illness, is advised. So not 65 or 67 in my case, but let's just say 70. All right. So we know maybe I'm 70. We know what your Social Security looks like. I didn't have a pension, but I have savings. So I'm going to, run a projection. And, I know what you've said to me, Suzanne, in our planning conversations is you want to feel a sense of security and knowing that there is a check in the mail every month. It's not going to be subject to the vagaries of the market and withdrawal from, my mutual funds, my stocks, my bonds. I've identified that, your budget says that you need $5,000 a month to pay, your property taxes, your groceries, just what it keeps to keep Suzanne alive, your health expenses, your Medicare. So what I'm seeing here is that, you've got $2,500 from Social Security. Let's take that $2,500 whole for what you need for that guaranteed income each month. And we're going to actually carve out a piece of your portfolio to actually buy an annuity that will pay you $2,500 a month as long as you live.
And so basically you're getting a plug number, basically figuring out your liabilities are, and then, okay, what's the amount of, possible deposit into an annuity that would create that function? Sounds like if I'm
and I think connecting it back to this concept of we're in a meeting, from a compliance standpoint, from being, possibly a fiduciary, have to show me the spreadsheet, right? How the calculations are made, how this guarantee works. But at the end of the day, fitting it back to what my need is. And oftentimes it is making sure that I have that security of knowing that, I've got that $5,000, coming each month, 25, let's say, from the annuity. That makes me that's Jay, that's what I want. Thank you for disclosing everything you had to disclose. But at the end of the day, that's my need. You filled it by having the annuity in the portfolio. And I get all my other investments to do what they're going to do.
Oh, and in fact, I'd even add on top of that, Suzanne, which is that if you have this extra layer, and I don't believe that this is actually in print. And I'm not saying I'm like groundbreaking idea author by any means, but when you have done it as you have described, meaning I've thought through my income, I now have a plug number I need to get to and have filled it, then your ability to take risk or accept different market risk is different for what remains of the rest, right? I mean, it changes entirely the way that you can think about risks for the rest, for other things, whether that I want to give it away to somebody else, I want to leave this to my children, I want to hit a home run for myself and, hit a grand slam. Well, you don't get to swing for the fences necessarily. But now if you have these plug numbers filled in as you described, okay, now you can, and very importantly, in a financial market that we have today, we've got 401ks minus 20%. I think that is, a very good general number. If you look at the, target retirement funds, pretty much irrespective of who the seller is. BlackRock, Fidelity, the best of class, noted best of class, minus 20%, certainly, even on a diversified portfolio, across a global one. But if they had the plug numbers, they could take the up and down a little bit more with more. It's not ever fun, but at least they could, understand that they have time to wait. Some other persons without that plug number filled in, they don't have that luxury. And so it's
and it comes down to, I think, what so many financial professionals have said to me over the years. I have an undergraduate degree in psychology, which I bring in all the time. I'm a huge fan and follower of behavioral finance. Daniel Kahneman is one of my kind of idols, in our industry and in the world, by helping us understand these behaviors that drive our decisions, especially with investing, and this wealth destroying behavior that comes out, like you're saying, in markets like we're seeing now. I mean, fear and greed, right? We talk about all the time. this is a really tricky time for someone who is, nearing or in retirement that says, this is it. Like, I don't have the capability or the desire to go back to work. This is what I got.
Right.
And, the Alliance for Lifetime Income has done a value study. There are, we couldn't even probably finish the conversation in a day about all the research that's been done
Right.
about how we can be better, both as investors and financial professionals, right, in thinking about the psychological landscape. And you talked about risk appetite. And that's a critical conversation to have because, I probably shouldn't say this, but my father is an interesting entrepreneur, is still 100% stocks. And always will be. Hates bonds, right? So, but everybody comes in all shapes and sizes. Me, I'm
Sure.
much more of a, probably moderate to moderate aggressive investor. What does that mean? That just means that I have the ability to absorb a little bit more risk and the financial kind of fortitude to absorb that risk. And maybe it comes from, as you say, I've got kind of the left brain knowledge to know that, regression to the mean, what goes up must go, what goes up must come down. What goes down is probably going to go back up again. But it's that time value that we're talking about here with someone who's older, and I think has maybe more of a sense of I can't live through this again. I mean, we've got a baby boomer generation that went through the tech wreck, went through the credit crisis. They see this happening, whatever persists with our current markets. And it's just not something that a lot of people want to absorb again.
Yeah, and it's tough. I mean, somebody put it better than I, right? Well, now I'm retiring, and I find the sandwich generation in a very, very tough spot, right? Because now, the runway is shorter compared to when they were 30, right? You're now 60 years old. You want early retirement. Now all of a sudden your 401k is down, notably down. And now also, since the runway is shorter, your path to filling that replenishing in the absence of markets, which have to basically go straight back up in order to get back to where you were on January 1st of this year. All of your resources, and this is unfortunately the way that, I mean, like you said about behavioral science, right? People don't find out that they could have done something about this 10 years ago, if they had known that these tools even exist, right? Which did exist, different flavors, but the same general concept. Like you said, an annuity is not a new product, at all. But so the tool and
oldest investments,
right, where you have this tool that had sat there. Yeah. And while people were, drinking the Kool-Aid of, well, markets straight up every year, I don't need to consider other tools. This tool my singular tool is the Swiss Army knife. And now all of a sudden, we've got gobbledygook, technical term, right? And now we don't have a good path, so tough. And, this is why I ask you about the resources for other generations. And for, because the 30-year-old, it's fine. 40, like you said, reversion to the mean, you have runway. 55, early 60, now the runway is notably shorter. Some persons unfortunately have outlived their friends at that age. So this is going to be a tough period, I would think, unless we have some snapback, which I'm not sure without a crystal ball. I don't.
Yeah, no, mine is very cloudy right now. I don't know about yours. Yeah, no, don't have one of those, unfortunately, to look at. But you made me think of something, Jay, which, and I get that we're, depending on the day, dipped. But one of the things that I found interesting with this contrarian view that I always try to adopt, right? Meaning that, we don't want to be in the herd. Nobody wants to be a lemming, right? Yeah. So I always try to adopt the contrarian view just to look at it, right? Not necessarily acting on it. But one thing that I've heard over the years, which I do think is interesting, is that, we always caution people, buy low, sell high, right? Or not caution, we advise, right? And not that I'm an advisor, but, that's a good rule of thumb. And behaviors tend to drive the opposite, right? Which is we can't help ourselves. We're going to track up and buy as the market's climbing, because it's always going to climb or it's always going to make money. And, we tend to sell when we're fearful and it's declining. The annuity, and specifically, in this lens, it's the variable annuity, I always found really interesting because what was nice about it is it lets you continue to invest. But at the same time, whatever my deposit investment looks like, maybe it's once, maybe it's continual, but the point is, my investment in it, that becomes my floor. Now obviously you and I both know, technically speaking, if you put in 100,000 and you take out 50, obviously the floor is not still 100,
right, for sure.
I can't think of any out there that would do that. But
no.
In the old days, if you adhered to a certain, like limited withdrawal, maybe that was preserved. But the point I make is that it's the contrarian investment often, because when you're buying it, you're almost like you want to buy high, right? Because it is risk managing if you adhere to, all the rules, but it's risk managing so that, you bought high when, the market's, like, oh, I have this 100,000. This is great. I invested 50 and now it's worth 100. And I put 100 into this variable annuity, and I obey the rules of the road. I don't take money out, that becomes the floor. So if the market goes down, then it's still at 100. And I'm in this case of the variable annuity, I am still an investor, buying sub accounts, mutual funds, and so I just always think about that investment in particular. Now, I'm not saying we're at the top of the market. Clearly, we both know we're not. But if somebody did make a lot of money during the recovery from the credit crisis, last crisis, it's something to think about. And then again, back to, it's a matter of what are your ultimate goals, right? Because if it is plugging this gap and having a guaranteed lifetime income stream in your portfolio, that's something that I think is worth a look.
How many steps does a person, they've listened to our podcast, watched this video, okay, now I'm interested to some degree. How long is it going to take them to get up to speed?
Yeah, well,
do you think?
Yeah, I mean, okay, so we're going back to the engineers. So maybe not that long. They like to dig through prospectuses and, look at the ratings and all that, and look at all the alphabet soup of annuities. I mean, you and I both know we could probably fill every letter in the alphabet with the types of annuities that are out there. Sure. Not to, again, scare people, but just to recognize that it's an array of choices. And I would say that that's where, if you want to do it yourself, it's probably going to take a little bit longer because you're going to have to put the pieces together. An advisor, financial professional that is licensed and has done the due diligence, has done the analysis, the comparisons, I would say it's probably not going to take much time other than just becoming familiar as an investor. What is this going to do for me? But trusting the financial professional that they've done the review.
I think that is super important, what you just said, which is it's not only the professional, right? Because we don't control the pricing, right? We don't control the output, et cetera. There's zero on that. But the real thing that you have stated multiple times here today, which is that the function, so vital. Without that, you're kind of nowhere, because otherwise then you're talking about, like you said, unlimited numbers of combinations of letters.
Yeah. Well, it comes back to, Jay, you made me think of, and I'm maybe not invoking enough analogies here, because the one that just occurred to me, which is, back to, I have a car. I did not build the car. I did a little kind of research, on kind of, I knew what I wanted. I live in New England, so I wanted all-wheel drive. I wanted an SUV. I like to ski, so, got gear and stuff. But the thought of me going in and saying, I went and know exactly how this thing was made, and the computer that's driving it and everything, I don't care. I want this car, and I went to a salesperson that could help me kind of decide, how what the extras look like. But the point being is, I don't need to know. I'm not an auto mechanic, and I don't have to know everything. But I need to go to someone I trust.
I have a question, and now you've opened a whole other can of worms, and I'm not going to delve into every last detail. Now you've gone to the auto mechanic and you've got a problem with your car, let's just say you go to 3 auto mechanics. Is there a marginal question, or is it just, I like this person, that you think that you're going to go to one of the 3 auto mechanics, using your analogy?
Sure. I think that, I want someone who has experience. I tend to be someone that goes to the dealer for that reason. I know that they've got someone that has been trained properly. They're backing, what work that they're doing. That's not to say that a general mechanic wouldn't be great, but
Right.
I think that there's something to be said for delegating, right? And I know that there are people out there that like to do it themselves, and maybe there is somebody who likes to tinker in their car, but I'm someone who wants to have that confidence and security, right? And I do think that having a in our bring it back to us in this industry is someone who is licensed. I've done a background check. I know that they hopefully have no client complaints, but knowing that they are someone that as I'm beginning to build trust with them, I think that's really critical in the relationship that you have with a financial professional. And one thing I will mention, there was a podcast that Gene Chatsky had yesterday in talking about with Pam Kruger, who's run a PBS special for years on how to look for an advisor. The Alliance for Lifetime Income, again, being a not-for-profit that's educating consumers, also has a checklist, and Pam's podcast is there as well, that gives you kind of some food for thought and what to be looking for, because some people may not have a practitioner that's licensed to talk about guaranteed income. And so finding that person, I think that has that experience is critical.
That is the perfect drop-off point here, Suzanne, because I was going to ask you exactly, are there resources from the organizations you're involved with that you're working in different roles to try to get persons on that path? I'm a single person, meaning that I'm a sole party, but I'm happy to share other persons with their way of stating it. So happy to have you, someone who has had experience, and then also contributing to different. You've got your own professional experience. You've got your roles with these other organizations and your perspective on complicated stuff here. So thank you so much for joining us here on Jay's Corner.
Thanks, Jay.